Welcome back to Talk Tickers. We are here to strip away the corporate press releases
Oh, yeah.
and get straight to the numbers that, actually move markets.
And today was a wild one.
It really was. If you were watching the screens today, you probably saw a lot of red. I mean, the broader indices were struggling. The mood was definitely risk off.
For sure.
But there was this one massive exception in, of all places, the consumer staples sector that we just have to talk about.
We are talking about the Hershey Company, ticker HSY, and their Q4 2025 results. And look, this was more than just a good quarter.
Oh, way more. Hershey didn't just beat earnings. They posted a move that suggests the big institutions are totally rethinking the entire investment thesis here.
It's a fascinating case study in pricing power, portfolio management, and frankly, how a legacy company handles a massive commodity crisis.
Exactly. So while everyone else was choppy, Hershey just sprinted. The stock closed the session at $224.38.
Which is up, what, over 18 bucks?
$18.49. That's about a 9% move on the day. But what really caught my eye wasn't just the price, it was the participation.
The volume.
The volume spiked to 5.7 million shares. For context, their 3-month average is like 1.7 million.
And that volume tells you everything you need to know. That is not retail traders chasing a meme stock on an app.
No way.
When you see volume triple on a 9% pop in a, let's be honest, kind of a boring stock like Hershey, that is institutional conviction. That is pension funds stepping in and saying the old valuation was wrong.
Okay, so let's get into why they think it was wrong. Let's hit the headline numbers first. Revenue came in at $3.091 billion.
Beating by about 111 million. And that's up 7% year over year, which is solid.
It is, but the bottom line, the earnings, that's where the real firework was. Non-GAAP earnings per share, $1.71.
And the street was looking for what, $1.40?
They're around $1.40, yeah, so that is a 31-cent beat.
Which is just massive for this sector. I mean, in tech, you might see that.
Yeah.
In consumer staples, where the models are usually dialed into the penny, a beat like that means the analyst just fundamentally misunderstood the company's leverage.
Right. But what really drove the stock today wasn't just the history, the Q4 numbers, it was the future. It was the guidance for 2026.
The guidance was shockingly aggressive. So they're projecting net sales growth of 4 to 5%. Fine, sounds standard.
Yeah, nothing crazy there.
But the adjusted EPS guidance is $8.20 to $8.52.
And we need to pause on that. Let's do the math for everyone.
Yeah.
If you compare that 820 plus number against their 2025 results,
You're implying earnings growth of 30 to 35%.
that's the number that just stops you in your tracks. 30% earnings growth from a candy company.
It sounds like a tech multiple.
Right. So how do you do that when everyone knows cocoa prices have been, at historic highs?
It's not magic, but it is a very specific combination of pricing and a strategic pivot that I just don't think the market fully appreciated.
Okay, so let's start with the revenue engine. The price versus volume thing.
Right. Management pulled off a high wire act here. Their pricing was up 9%. Now, usually when you raise prices by almost double digits...
You expect demand destruction.
Right.
If a candy bar gets too expensive, I just stop buying.
Exactly. But volumes were only down 3%.
So they charged 9% more and only lost 3% of their customers on the transaction.
And that spread is pure margin. This gets to a concept called elasticity. Wall Street analysts build models based on this, basically a number that predicts how much volume you lose for every point you raise the price.
And the assumption was what?
The models were all assuming an elasticity factor of about 0.8. So for every 10% price hike, you lose 8% of your volume.
That's the standard playbook.
Correct. But Hershey just blew that model up. The consumer proved to be far, far less sensitive to the price than the spreadsheets predicted.
And why is that? Just brand loyalty to Reese's.
It's partly brand power, for sure, but it's also the specific price point. Management kept calling it their affordability defense.
Okay.
Even with all this inflation, 75% of their portfolio is still priced under $4.
So it's an accessible luxury.
It's the last luxury to go. You might skip a vacation, but you'll still buy that $4 treat.
It's the lipstick effect for peanut butter cups.
Ah.
But look, we have to talk about the other side of the house. Everyone focuses on chocolate, but the real strategic story here is in the salty snack aisle.
I could not agree more. This segment is often seen as, like, a side project, but in Q4, salty snacks became the growth engine. North America's salty snack sales were up 28%.
28%, and that wasn't just price, right?
No, and that's the key. While the chocolate side had falling volumes, salty snacks had double-digit volume growth. Organic growth was 18%.
And they called out SkinnyPop and Dots.
Yeah, Dot's Pretzels is now the #1 pretzel in the category.
Okay, so from a business perspective, this is a huge deal. Because cocoa is expensive, it's volatile, but pretzels are what? Flour and salt.
Precisely. You're hitting on the diversification thesis. By growing salty snacks at 28%, they are fundamentally changing their input cost mix. They're swapping out cocoa butter for wheat and corn.
It's an operational hedge.
It's a perfect operational hedge. When your core commodity gets hit, this other division that uses totally different, cheaper inputs saves the day. It balances the whole portfolio.
So it buys them time while they deal with the cocoa mess.
Exactly.
Which brings us to the elephant in the room, the cocoa bean. We've seen headlines about a precipitous decline in spot prices. Looks like the bubble popped. So what's the reality for their cost structure?
This is where you separate the casual observer from the pros. Yes, spot prices have crashed in the short term, but a giant like Hershey doesn't buy cocoa on the spot market. They hedge.
They're using futures contracts, locking in prices months or years in advance.
Exactly. Management was very clear. Their 2026 costs are fully understood, and they are hedged above the current spot price. They are still paying for the peak of the crisis.
Okay, that sounds like a headwind. They're paying high prices while the market is falling.
It does, but here's the aha moment from the call. The CFO mentioned they use flexible hedging. This allows for what he called downside opportunity.
Meaning if prices keep falling, they can still participate in the savings.
That's it. They have protection on the upside, but they can benefit from the downside. It means that as we go through 2026, the cost pressure eases. They guided to a 41% gross margin in 2026.
Which is way up from where they are now.
Significantly. And they said the recovery is weighted towards the back half of the year.
And if cocoa stays down, then 2027 is set up to be a massive year.
That's the whisper. That's why the big money is buying today. If spot prices stay low, those hedges rolling into 2027 are at much, much lower rates. You go from a headwind to a massive deflationary tailwind.
And they're not just waiting for that, they're spending. Usually, a company in crisis mode cuts costs, slashes marketing.
They hunkered down.
Right. Hershey seems to be doing the exact opposite. They're going on offense.
They literally called it the year of Hershey. They announced a double-digit increase in advertising spend for 2026.
That's bold when you're trying to recover margins.
It signals incredible confidence. They're launching new campaigns, a huge push for Reese's, leveraging the Olympics, the Final Four. They want to be always on.
And they mentioned the Reese's Oreo product.
Which is just smart. You take two power brands, you mash them together, and you get instant sales without having to teach the consumer what it is.
And it sounds like they're feeling confident enough to open the wallet for shareholders again, too.
That was a subtle but really important signal. The buyback conversation is back on the table. Dividends are growing again. CapEx is normalizing.
The storm is passing.
When a CFO talks about buybacks, they're telling you the crisis is over. They're not hoarding cash anymore.
Okay, let's pivot. Investor context. We have to talk risks. The two big ones on the call were S&P waivers and, of course, the Ozempic question, the GLP-1s.
It's the question every food CEO gets. Hershey has a dedicated team on it. And so far, their data says the impact is minimal.
People on weight loss drugs are still eating chocolate.
It seems so. And as for S&P, the Food Stamp Benefits Management called it manageable. Only 2 of the 12 affected states have even implemented the waivers yet.
So manageable headwinds. What about internationally?
That's a bright spot. They're gaining share in Canada, Mexico, Brazil, the UK. But there was this really interesting point in the Q&A about Europe versus the US.
Yeah, I caught that. It sounds like European consumers behave totally differently.
They do, and it highlights Hershey's moat. The European market is dominated by chocolate tablets, just blocks of chocolate, and private label brands.
The generic store brands.
Exactly. So when prices go up, Europeans just trade down to the generic stuff. Elasticity is very high.
But in the US, nobody wants a generic peanut butter cup.
Exactly. A Reese's is a Reese's, a Kit Kat is a Kit Kat. Private label is tiny in U.S. confection. That brand loyalty, that differentiation makes the U.S. market so much more resilient. It's a structural advantage.
So if we zoom out, the whole narrative has shifted. Coming into this, the market was pricing in like a cocoa apocalypse.
A total apocalypse. They were looking at a cliff, a shock that would destroy earnings for years.
And now?
Now they're looking at a bridge. This call anchored the story around earnings power recovery. Investors see a clear path to 2027 where margins expand and costs stabilize. That's why you get a 9% pot.
A bridge to a sweeter future. I like that. All right, buckle up. It is time for our This Is Not Financial Advice segment.
And the standard disclaimer applies. We are just two voices with microphones. We are not your advisors. Do your own diligence. Don't trade with money you can't afford to lose.
You got it. But let's put on the hedge fund hat for a second. I'm looking at this setup, and I see a disconnect between 2026 and 2027. I'm calling this trade the 2027 Sweet Tooth Slingshot.
Okay, I'm intrigued. Walk me through it.
So the market just priced in the stabilization of 2026. That's the 9% move today, relief. But I don't think it has fully priced in the margin expansion supercycle of 2027 yet.
You're talking about the cocoa hedging lag we just discussed.
Exactly. The spot price crash we see right now doesn't really hit their P&L until 2027. So the trade is this. You look at deep out-of-the-money ELA calls for January 2027.
So you're betting on the explosion in 27, not the gradual recovery in 26.
I am betting that the downside opportunity in cocoa, plus that insane 28% growth in salty snacks, creates a margin explosion that analysts are just too scared to model yet.
It's a classic cyclical play. Buy when the input cost is high but falling, knowing the benefit is delayed. What are the risks?
Well, EPS are expensive, time decay can kill you, and, cocoa prices could spike again, or the GLP-1 thing could actually become a real problem.
True. If you want to get fancy, you could structure a pair trade. You go long the Hershey EPS and you short a generic European packaged food ETF.
Playing the U.S. brand resilience versus European private label theme.
Exactly. You're long the pricing power of Reese's and short the commodity-like exposure in a weaker economy. It hedges out the general people are eating less sugar risk.
That's a sharp way to play it. Long the moat, short the commodity.
It's an idea. The setup is definitely there.
All right, let's wrap this thing up. What's the bottom line takeaway for everyone listening?
Hershey delivered a beat and raise for the ages. Salty snacks are carrying the growth, chocolate pricing is sticking, and the cocoa panic is now just a manageable cost problem. They turned a crisis into a transition.
And if you want to dig deeper, circle your calendars. March 31st is their Investor Day in New York. Management promised to unpack their long-term algorithm.
That's where we'll see if the slingshot thesis has any real legs.
Until then, keep your portfolio sweet and your stops tight. We'll see you on the next ticker.